Welcome to PIMCO Pod. In this episode, we discuss how higher rates, weaker underwriting, and software concentration are exposing vulnerabilities in direct lending and leveraged loans, while high-yield bonds appear better positioned. Stay tuned after the conclusion of the podcast for additional important information. The Credit Market Lens, a growing divide in leveraged finance by Lotfi Karui. In June, a healthcare software company announced an amend and extend transaction to push its previously agreed 2027 loan maturity further into the future, the first leveraged loan software issuer to do so this year. The transaction is unlikely to prove idiosyncratic and may instead mark a broader shift. Financial distress is likely to rise in direct lending and leveraged loans, even if the business cycle remains resilient. This kind of distress is usually cyclical, surfacing when earnings weaken and financial conditions tighten. As discussed in PIMCO's Secular Outlook, Rupture and Resilience, the emergence of credit market stress alongside stable growth in a resilient economic environment points to internal pressures rather than macro fundamentals. Divergent paths in leveraged finance markets. Loan markets under strain. Three forces help explain the stresses in loan markets amid a more broadly benign macro backdrop. Higher rates continue to flow through unevenly across capital structures. The roughly 500 basis points, BPS, of Federal Reserve rate tightening delivered between March 2022 and July 2023 has weighed heavily on direct lending and leveraged loans, where floating rate exposure has driven a sharp increase in interest burdens. That has eroded interest coverage even without a growth slowdown. By contrast, high-yield issuers, which are predominantly fixed rate, have been partially insulated, delaying the transmission of tighter financial conditions. Direct lending is dealing with a growth hangover. The post-COVID fundraising cycle left a massive pool of committed capital to be deployed into a constrained opportunity set. Excess capital chasing limited deals predictably weakened underwriting. Looser covenants, aggressive EBITDA, earnings before interest, taxes, depreciation and amortization, add-backs, permissive documentation, deferred coupons, larger deal sizes, and greater portfolio overlap across managers. In short, competition eroded many of the protections meant to compensate for leverage and illiquidity. Software will likely amplify these vulnerabilities. Sponsor capital in direct lending and broadly syndicated loans has been heavily concentrated in the software sector for understandable reasons. Recurring revenue, high margins, and predictable cash flows that supported elevated leverage and valuation multiples. But AI disruption has started to challenge the math behind many software leveraged buyouts, LBOs, raising questions about pricing power, customer retention, and margin durability. Software has therefore become not only the largest sector in both leveraged loans and direct lending, according to PitchBook, but also a key transmission channel for stress. Relative strength and stability in high-yield bonds. If the macro cycle remains intact, the important distinction is between markets where excess capital has weakened underwriting and those where fundamentals have improved. In our view, the high-yield HY bond market stands out. It looks stronger than its own history, stronger than leveraged loans and direct lending, and less exposed to the supply-demand imbalances that have built up elsewhere in leveraged finance. That relative strength is visible across several dimensions. The HY market has remained broadly stable in size since 2016, while leveraged loans have grown by roughly 70% and direct lending has expanded several-fold, reflecting sustained inflows into private credit. Overall, HY credit quality has also improved. The share of BB-rated bonds has risen to a record 54%, up from 30% in 2010, while the BB share in loans has fallen to 28%, down from a peak of 45% in the wake of the global financial crisis, GFC. This partly reflects issuer composition as well as the growth of secured issuance in the bond market, which now approaches 40% of the HY universe, as represented by the Bloomberg U.S. Corporate High Yield Index. Average duration in HY markets has also declined, driven by post-2022 repricing and a shift toward shorter maturities. This helps reduce sensitivity to rate volatility and lowers overall risk. BBCLOs. Marks don't need downgrades to hurt. The valuation reset that swept through software earlier this year remains largely unchanged, suggesting investors are still in show-me mode and want evidence that AI will expand the industry profit pool rather than reshuffle it. So far, the broader leveraged loan market has contained the damage despite software's meaningful index weight, but the vulnerability lies beneath the surface. Much of the software loan universe is rated B-, leaving it exposed to downgrades if operating performance surprises materially to the downside. A migration into CCC territory would matter not only for software loans, but also for the broader collateralized loan obligation (CLO) ecosystem, where rating constraints could amplify dispersion. The most widely watched metric, the share of CCC-rated loans, remains below the typical 7% threshold in most deals, though it is close for deals nearing the end of their reinvestment periods. Within the CLO market, market value over collateralization, MVOC, which measures the market value of the collateral pool relative to the par amount of a given tranche, plus all tranches senior to it, is also flashing yellow for deals nearing the end of their reinvestment periods. This matters because once collateral values no longer fully cover liabilities higher up the capital structure, the system becomes more sensitive to further price declines. As reinvestment periods expire, managers also lose flexibility to rotate out of weakening credits. A wave of software downgrades could therefore create pressure beyond the sector itself, not necessarily through realized defaults, but through weaker marks and reduced structural protection. At the index level, this supports a continued preference for HY bonds over leveraged loans. It also means relative value between the two markets should not be framed simply as a carry versus duration trade-off. Duration can be hedged. Structural credit deterioration is harder to offset. Thank you for listening. That was the Credit Market Lens, a growing divide in leveraged finance. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.